Welcome, everyone. Another episode of Financial 15. Kevin and I are ready to go. Lots of great information today. We're doing part 2 of our talk on recession, looking this time at how does a recession impact the stock market. Lots of great information. You want to stick around.
Yes, we've already given the definition of what a recession is, and now we want to let you know how a recession affects the stock market. When, where, when's it over, the whole 9 yards. So you need to see what's going on with that. If you want to find out our other recession videos or any other ones we've done, please visit our YouTube channel and subscribe. Lots of great content there. You'll be very happy you looked at it. Or like us on Facebook. And most importantly, please visit beckerorr.com, our website. There is great information there, and it can help out with a variety of different things. But today we are talking about recession's impact on the stock markets. Every time somebody comes up with that R word, we want to know how it impacts the stock markets. Are they going to go down? They're going to go up? Clint, what do we have to deal with on here?
Well, let's just jump right in. We'll get right into the data, look at some of the history. So, all right, we know when recessions occur. We've got the dates. What happens in the markets during those times? This is from Ben Carlson, Wealth of Common Sense. He looked at U.S. data. Now, he went back pretty far, went back all the way to 1928. So it does include the Great Depression and some time periods that may no longer be relevant to today, but still gives us a good idea. And you can see he added the data and said, well, if you get a bear market, so the stock market goes down and there's an economic recession, on average, the market goes down a little further and it lasts a little longer. That's really the takeaway here, is that I wouldn't put too much stock in the exact number. It's going to be exactly minus 33% or whatever the exact number is. I think it's going to vary from time to time, but that would be the general premise. Would you agree?
Yeah, I would say so. I mean, that's exactly it. I mean, basically, you can enter the bear market, as it mentions, in two fashions, either with a recession or without a recession. And as we've proven, if it's recessionary, you're going to have a little bit more downside. You're going to have it last a little bit longer before you can get away from it. Whereas the non-recessionary scenario is a little bit less. So, I mean, when everybody talks about soft landing is basically we're probably not hitting recession, at which point that's a non-recessionary one. It may not last as long. But I think one important thing to look at is even in this time frame, if you look at it, you're looking at a year at the long side, and you're looking at maybe 2/3 of a year on the short side. Compared to bull markets, which tend to run 4 or 5, this tends to be a smaller time frame as well.
Exactly. And that's a bit of U.S. data. Now let's dig in a little deeper with some Canadian data and something a little more recent, perhaps a little more applicable. So I dug into the data here. I looked at the C.D. Howe Institute, which in Canada is kind of the arbiter of recessions, of when they start and when they end. So you can see the official dates on the leftmost column there. And then we looked at the S&P TSX total return and said, all right, if those are the dates, what happened before the recession, what happened during the recession, and what happened after? Now, before, you can see generally the market dropped. I think 2020 there, we see the big green number. That's probably the exception rather than the rule. We had the pandemic. That was a bit of a surprise in terms of what happened. But generally, markets are down a little bit leading into the recession. During the recession, they tend to be in the red. You can look at the 1991. The market was essentially flat throughout the recession. But the big takeaway here is you get a sea of green pretty much in every case afterwards. 1 year, 3 year, 5 year. It's quite a positive reaction once the recession is over.
Yeah, and I would say basically, I mean, you're right. With the exception of the anomaly one down, which was the pandemic, and of course, that's a completely different scenario to deal with. Basically, what you're finding is that the market tends to be a leading indicator. So the markets start to go down before the recession ever occurs, because all of a sudden people are thinking that, we're close to a peak of some format, or you start to see growth slowing beforehand. People have already started to move the market downward. And by the time you get to the recession, it could go further, as you've seen in 2008 to 2009, or as you mentioned, the 90 through 92, it basically flatlined after it went down initially. And again, as we've seen, once you hit that recovery phase, everything starts to go up, and we've got a 1, 3, 5 year, at least right now, that is positive no matter what.
Yeah, and some pretty big numbers there as well. Pretty big numbers. I mean, you go with the 5-year time frame, some very strong double-digit numbers on that part. But the general message here, what you just talked about, stock market being a leading indicator and front-running the economy in some extent, really that the economy and the stock market are not necessarily in sync. They don't move one for one. One tends to move a little faster than the other. So using the recession, using that R word as some kind of timing tool of what to do with your investments could be very, very difficult. because we don't know we're in a recession when it happens, because those dates I mentioned, the official dates, those come well after the fact. And then, as we talked about, the market usually moves first anyway. So even if you somehow knew the dates, it still might not be the best timing tool. So timing what to do with your investments based on whether or not they're in a recession, very, very difficult. And frankly, probably not a worthwhile effort in terms of doing investment strategies around timing of a recession. And we'll kind of show that point here, Kevin. We'll go through some more data. This is the Canadian stuff. Let's get into some of the U.S. stuff. This is from NBER, the National Bureau of Economic Research. They are the official arbiter of recessions in the U.S., so they determine the official dates. CD Howe kind of fills that role in Canada. But you can see there, Kevin, look at the announcement date, and then you can see the beginning and the end of the recession. There's a pretty big gap from when they make the announcement and when the recession actually occurred.
Well, it's huge. And again, I mean, one of the ones that always stands out to me is going back to 2001, where if we look at the beginning of it, well, the beginning was March of 2001, and we didn't announce that until almost the end of the year. November, almost the end of November, they announced that, oh, well, you know what? We're in recession, and it began in March. Meanwhile, the end started after they announced the beginning. And of course, we don't find that out for almost 2 more years that it ended. So again, I mean, you don't know you're in recession when you're in recession. That's the problem, is because you have to collect all the data to figure out whether you're in recession, and you can't do that until after it's actually occurred. So again, I mean, trying to time it, trying to be a leader in this and say, oh, well, we're going into recession, I got to do this now. It's almost it's an inexact science. You can't do that on a regular basis.
Yeah, you'd be looking at leading indicators and making some guesses and estimates, more in the speculation category. And this isn't to knock the economists, because they have a tough role here. The data they're collecting is always backwards looking. They get data today that says what happened last month or 2 months ago. And once they get enough data, then they can make an official announcement and say, you know what, we're seeing it across the data here. The economy has slowed down. We're in a recession. And we believe the start date was, 2 months ago, 6 months ago, or whatever the case may be. For example, in December 1st, 2008, that was the announcement date. They said, yep, by the way, the recession started December of 2007. So they told us the recession started a year ago. And then in September of 2010, they said, by the way, June of last year, the recession ended.
It ended.
Yeah, and again, I get it. It's a slow-moving mechanism. The economy is a little more complex, lots of moving parts. They need a lot of data before they can make any kind of official proclamation. But again, it gets to the timing aspect. If we're going to use this R word, the recession word, to try to do something with our investments, probably not going to be the best tool because of the huge lag in when we actually get those beginning and end dates for the recession. And we'll use a visual representation of this here. Kevin, you can walk us through it. We took those dates, the actual announcement dates. So earlier, the data we looked at was the official dates, which we only know in hindsight. We took the announcement dates and we put it onto the S&P 500 chart here, so you can see what the chart looks like, and then when they told us, not when the recession happened, but when they told us the recession began, which was the blue line, when they told us the recession ended, which is that purple line there. And you can see it's not the best indicator, is it?
No, and I mean, that's exactly it. Whether it's beginning or end or peak or trough, same sort of scenario. I mean, we can look back, but I mean, even just starting sort of for that 90, 91 sort of area, I mean, we're already announcing that you're in recession and the market is going up. And then by the time they've announced that we're out of recession, the market's up even further. So recession happened earlier, but they didn't announce it until we were already out of recession. I mean, when we started to get to that 2001 thing, it was the same thing. The tech wreck came. Well, the market had been going down for almost a year by the time they announced it. Yes, we're in recession. So yes, it did go down a little further over the course of the next year, but it had already started going up by the time they announced we're out. And then, of course, if you take the last two examples, they're more significant and severe. I mean, you have a huge drop coming at 08, and okay, fine, we're in recession. Not much longer, and then we start going up, and we've almost recovered the entire amount by the time they announced we're out of recession. Same thing happening in 2020. We're way above where we were at the beginning of the pandemic, and well, now we're out of recession. You're announcing it in 2021. Yeah, we knew that, even though it was short term. So you're right. I mean, it is not a good indicator by any stretch of the imagination. And again, what we can see from some of these charts is that not all recessions are the same either. I mean, some are very severe, some are really short, some are not as severe. So I mean, a 20% correction, maybe that's not a bad one. 40% may be a little worse. But what we're trying to tell you is that the markets and the recession scenario, they don't really correlate. You're usually, one's a leader, one's a laggard.
Essentially, yeah. If we're trying to sum it up here, it's the idea that markets tend to drop prior to the official start date of the recession. You normally see some market deterioration before the recession happens. there can be turbulence during the recession, but by the time they give you those dates, it's normally too late. By the time they say, yep, we're officially in a recession, normally the recovery's underway. And by the time they say the recession's over, normally the recovery is like just taken right off. So using those official dates as some kind of barometer, there's a lag there, right? Like you talked about, markets tend to be leading, economy tends to be a bit of a laggard. So they're not necessarily in sync, not really good for timing when it comes to your portfolio. Anything you want to add, Kevin?
Hence when we add things along the lines of it's time in the market, not timing the market, that tends to happen. Because if you're trying to time the end of a recession, you've missed a lot of the upside from that point. Otherwise, I think this gives us sort of a quick and high overview of what recessions impacts going on because of what moves on in the stock market and how it affects each other going forward. But if you want to have more information on this or anything else that we've talked about in our videos, please go to chatwithclintonandkevin.com. Lots of great content there. Not only that, but we would love to answer any of the questions you have, especially at this time where things tend to be a little more volatile. Other than that, I think we've given a brief scenario as to what a recession is, how it affects in the markets, and what the markets do based on a recession. And I think we're good for that.
We'll leave it there. Take care.